Thank you very much for the introduction. And absolutely. Clearly, in the last few years, we have had a huge amount of developments, both in terms of geopolitics, as we've discussed today, and also in the macroeconomic environment. So I think what we aim to do today is really assess how investor appetites are shifting towards emerging markets and how the risks and opportunities in emerging markets are presenting themselves. So before we go into the discussion, we'll just start with a quick round of introductions. So perhaps, Taimoor, if you could just start introducing yourself and a little bit about your firm and what you're focused on, please.
Yeah, thank you. Hi, everyone. My name is Taimoor Labib, founding partner of Affirma Capital. We manage about $5 billion AUM. We're an independent emerging market PE firm in Middle East, Africa, and Asia. And actually, we spun off from Standard Chartered Bank 5 years ago. We did an MBO. So we were a long time inside Standard Chartered.
Thank you, Cameron. Welcome, everybody. My name is Mark Price. I'm the regional head for financial markets for Africa and the Middle East at Standard Chartered, based here in DIFC and covering, I think, some of the most interesting markets on the planet.
Great. Hedi bin Mlouka. I am the founder and CIO of FIM Partner. We are a 4 billion institutional asset manager across investing money across emerging markets with a large presence in the MENA region.
Samia, Bouazza, founder and CEO of Multiply Group. Multiply Group is an Abu Dhabi-based holding company listed on the Abu Dhabi Stock Exchange. We invest and operate in 4 sectors: mobility, energy and utilities, media and comms, and beauty and wellness.
Okay, fantastic. Well, thank you for the introductions. Perhaps, Taimoor, to start with you, clearly a lot has happened over the last several years ago. I mean, from your perspective, how would you describe how the emerging market space more generally has evolved over the last 5 years or so?
No, thank you. I mean, if you look 5 years ago, we were at a very different time. So 5 years ago, you were right before COVID. Rates are 0% for 20 years. You can make a lot of money, beta. China is on fire. India is muddling through. And now you take a step back, 5 years later, no one wants to touch China. India is doing phenomenally well. Rates are, 3.5%, 4%. So I think it's when you think about EM, it's very important to realize that EM now moves very quickly. It used to move a bit more, I think, in lockstep with the West. I think that's less so. And I also think now, if you have good governments behind some of these markets, they can make major changes much quicker than other geographies. So I think when you think about EM, you can't think about it as a monolithic region or worldview. You have to really decide what does that mean to you, both in terms of countries and sectors and asset classes.
So just as a follow-on, I mean, you mentioned that about the fact that emerging markets as a block isn't moving in step with developed markets as perhaps as it has done in the past. Would you say that emerging markets today are they more fragile or less fragile, compared to considering the risks that are taking place in developed markets? So would you say they're more sensitive or less sensitive in this environment?
Look, I think we have to decide, which countries are we speaking about. So, for example, India has had a phenomenal 24 months. Anyone here who's been in India, either on the public or private side, has done phenomenally well. At the same time, if you've been in China the last 2 years, you may never go back to EM again. So it really depends, where you sit and what is your thesis. I do think EM is still correlated to the West and rates. I don't think that will change in our lifetime, because you still have a lot of carry trades and you have hot money entering these countries. So I don't want to say that there isn't a correlation, but certainly the direct correlation that we'd seen sort of 20 years ago is now much, much less. If you have very strong government policies in some of these countries, you can actually will yourself to very positive outcomes.
Okay. And Mark, anything else to add to the discussion? Just reflecting on how emerging markets have shifted over that time frame.
Thanks, Cameron. So let me start by saying that the continued economic resilience that we've seen in the US, the relative strength of the dollar, I think has made life very difficult for the emerging markets over the last decade. And that strength has continued, whether geopolitical events, cut through COVID, trade tensions. And for what that's meant for Western investors is, why emerging markets if you can earn double-digit returns at home in your own backyard with things that you know and see every day. However, I think with the Fed now starting to cut, the US economy starting to slow down a little bit, the dollar starting to weaken, it begs the obvious question, is now the right time for an emerging markets comeback? And because we thought so, we spoke to about 400 of our financial institution clients over the last few months and asked them for their opinion. What did they think around, was it now EM's time? And the feedback for them was very consistent. They did think that it was time for an EM comeback, and they did think that it was time to put money to work. But at the same time, the amount of money that is currently at work is very, very light. And I guess what that leads to is, what is the impetus that's going to put more of that money and divert it from perhaps some of those Western assets? So we're seeing the EM central banks also getting into a rate cutting cycle, which I think will help. Many of them have been taming inflation as well. That's also going to be very helpful. And there's been some bright spots. We've seen massive inflows into China after the stimulus announcements. But we've seen a few hiccups as well. Malaysia had one recently after the currency depreciation sparked some big outflows. So I think the jury's convinced that it's the right time for EM, but it's not convinced enough to put the money to work yet. So where I sit, I think that means that hopefully we get through the US election cycle, we get through the next couple of Fed meetings, we see rates continue to come off, both short-term, long-term, and then I think we'll start to see that pivot. And for us, that means the areas of most interest, perhaps EM local currency debt, performing strongly, whereas we see EM hard currency debt and perhaps EM equities continuing to sort of be laggards to that local currency. But we need a little bit longer before I think the EM bulls can go all in.
Right, okay. And Hedi, anything to add on that point?
Yeah, sure. I mean, maybe put a few numbers around what Mark had just described. The emerging market asset class over the last 10 years has delivered in dollar terms 4% IRR. That compares with 13 to 14% for the S&P. So had you put $100 in the S&P 10 years ago, you would have $350 in hand today compared to $150 had you invested in MSCI EM. So basically in terms of profits, your profit would have been 250 versus 50, which is basically 5 times. That's bad enough, right? I think what's interesting here is that if you look at the years, the 2000s years, so 2001 and 2007, until 2008, and probably if you're 40-year-old and younger than that, you wouldn't have witnessed this period, but it was actually exactly the opposite of that. EM has delivered something like 20 plus per annum with the rise of India and China at the time, whereas the S&P was one of the most boring words at the time, delivered something like 4% per annum. So I think, look, the trade that we're talking about where EM is a bad word and obviously S&P is everything, is a very crowded trade. And most people have forgotten about what EM can deliver. Now, if you look at these numbers in a little bit more detail, you will find that the gap of IRRs is driven by mostly 2 big drivers. One of them being the currency effect that you alluded to, and obviously that's emanating also from dollar strength that didn't help emerging market debt in general at the macro level. And the second one, obviously, the vast majority of the returns on the S&P are from the FANG and from technology companies. And unfortunately, obviously, this is a sector which is still underrepresented in emerging markets. Look, my view is that global allocators have started understanding EM much better. They understand it's not a homogeneous place to invest in. And as Taimoor has mentioned in the beginning, look, 5 years ago, it was China, now it's India. So it's a big place to invest in, but it's a very dynamic place. So it's all about dispersion of returns, and it's all about local knowledge, asymmetry of information, which you don't have in developed market. And if that's what you focus on, I think emerging markets can deliver very good returns. I think the last point I would want to make is that one thing I think global allocators miss when looking at emerging markets is that the alpha generation in emerging markets is much, much higher than it is in developed markets. And this is confirmed by several research papers. 2/3 of the managers in emerging markets outperform their index, whereas in developed markets, it's the other way around. 2/3 actually underperform.
Yep.
So this basically confirms that if you look at returns in emerging markets, you need to look at them at the combination of beta and alpha, and not just beta.
Okay, absolutely. A lot of interesting things in there. I mean, clearly, emerging markets have seen pretty stiff competition from developed markets where conditions have been favorable, especially in the private equity context, right? When you've had buyout, you know, we haven't had a better environment for buyout in the several years prior to the pandemic. So that's certainly interesting. And the difference really, just looking at the indices, emerging market returns versus developed markets, I think the thing that everyone finds remarkable is just the fact that we've seen all this value creation in emerging markets, all this wealth generation, but not much of it is translating to the actual public indices, at least when we look at the index. And your point on alpha is absolutely right. So Samia, firstly, any additional observations when it comes to the evolution of emerging markets over the last 5 years that you'd point out? And also, how do we explain the contrast between public and private when we think about emerging markets as well?
Yeah, well, so much has happened in the last 5 years, and I would say emerging markets have benefited from some of the geopolitical events that happened. Some of them, as a bloc in general, have strengthened. And if we look now for the arguments in favor of the growth and the returns of emerging markets, you see as interest rates start to decline and the dollar softens, it will make it easier for emerging markets and economies to borrow and service their debt. You look at these markets and you've seen some markets benefit from, for example, if we talk about Mexico, it has greatly benefited from the tariffs that the Trump administration had imposed on China and found a way to grow their manufacturing and trade with the US. The same could be said about India and the China +1 initiative when China stayed on lockdown. So there were a couple of factors, not to mention across the board, very young populations across very big, very large markets. India, 1.4 billion people, half of them are young population, willing to embrace AI, digitization, and creating dynamism in the economy. And the same would apply to Indonesia, to Egypt. We've seen also in the last 5 years, last month I was in India with a government delegation under the CEPA agreement. And you can see clearly the Bondi administration pushing for AI, clean energy, digitization, chips. And you see a lot of young talent, very intelligent, bright minds who are contributing to that growth. So yeah, but I do agree with what Mark has said. We can't just talk about emerging markets as a whole. I think we in Multiply, we get more granular. And we've invested in some of them. We've looked at other deals. So yeah, we have to be more granular and study always the balance between risk and return. On the point of public and private equity, both have their opportunities and disadvantages. As a public company, as an operational holding, our ultimate goal is to grow operational EBITDA, right, and create value for our shareholders. So emerging markets promise good returns, but as I said, we have to manage the risk. If we talk about public markets, the opportunities are, again, in general, they have been, stock exchanges in EMs have been offering better entry valuation. They've been trading at lower PE to EBITDA multiple. I've read 11 versus 18 in a developed market. And that's an opportunity for us. We go for majority shareholding because we look for companies to acquire and accelerate their growth. So that's a very interesting starting point. Also, public equities in emerging markets tend to be better governed and have more readiness for international investors in terms of audits and data and what else. However, the disadvantage is typically such markets are more susceptible to volatility, to economic volatility and geopolitical tension. Private equity, on the other hand, also offers a few opportunities. We've seen that in emerging markets, if we talk about deals we've looked at in Egypt, in Indonesia, in Turkey, and in India, not all of them have been closed. One has been in Turkey. We'll talk about it later. But we've seen management more eager to learn from us what we've done to our subsidiaries in Abu Dhabi and embrace it, whether it's digital transformation, efficiency initiatives that get launched. And because of the agility of the private company, we see a direct impact on the bottom line and we can create more value. The flip side of that is perhaps they're not as ready in terms of data. We have to do, obviously, our type of due diligence, legal, commercial, financial, as we do in any investment. But more importantly, in emerging market, you focus on currency mitigation. So we either go for private companies that offer, that are naturally hedged against the currency, whether in dollar-denominated exports or contracts, or we insure currencies. So in a nutshell, as long-term investors, we look for well-run, profitable companies, and we see where are the pros and cons and try to enhance their performance.
Okay, sounds good. So is it fair to say that, based on the feedback on public markets in emerging markets, the representation there, outside of a couple of markets, perhaps India and China, there's not a particularly good representation of the underlying investment opportunities. Is that a fair statement, or is that something you'd agree with?
I think as these economies develop further, you will see more and more participation. Not always the market performance is aligned with economic growth.
Sure.
Markets usually highly depend, especially when there's big float and retail investors, they highly depend on people's psychology and fears. And if you look at what's happening now, we've got 2 wars happening. We've got, in the last 5 years, we had COVID, we had the Russian-Ukrainian war, we have now the Arab conflict. And that explains why markets are trading at almost 25% less valuations. That's interesting for investors, but that doesn't mean that the economy is not growing properly. And I think we'll see more and more participation of such companies as reforms, governance, and policies start to get more mature.
Okay.
And if I may add to that, if you look at the GCC, actually is a very good example of that. If you look at the last 5 years, you've seen the ECM markets extremely active, and the representation of several sectors of the economy in the stock market has increased dramatically. This has been the most buoyant region in the world in terms of ECM and IPO activity. Not 1 month goes by without us seeing a few IPOs, and these are decent-sized IPOs with great companies. So I think as emerging markets grow and the capital market reform is there, there's definitely appetite from investors for good companies to be listed here.
So Mark, over to you. I'd love to get your take on the regions that you see as more appealing in this environment. We touched on a few before, but what's your take?
Thanks, Cameron. So Standard Chartered is an emerging markets bank, and we're lucky and privileged to have a presence on the ground in many of these markets. which helps us to advise our clients because of our willingness to take that jurisdictional risk appetite. And I think all of us have said that, our clients do need advice because you need to be picky about where you're willing to invest and why. So what does that mean in terms of, I guess, where we have, conviction or positive vibes around some of these markets? As a region, South America looks very, very interesting to us. In particular, Brazil, Mexico. Samia talked about Mexico. I was lucky enough to be in Brazil twice this summer. They are super, super focused upon inward investment, building that trade corridor between Brazil and the Middle East, Brazil and Asia. The 400 clients I mentioned before are very positive upon both those two countries. They're two of the most economically resilient emerging markets globally. And we think that that's a standout area. They're both going through a little bit of a slowdown at the moment, but the fundamentals are super strong. Bringing it closer to home, I think we have to mention the fantastic work that's going on here in the UAE and in Saudi, the real dynamism that's been brought to the markets, talking about the IPOs, et cetera. I think 16 in Saudi already this year. The changes to the market infrastructure, the market regulations in both of those economies and the wider GCC really does make that look like an attractive long-term play to us, to investors. And yes, we have to recognize the geopolitical risks that are present at the moment. But I think even withstanding those, it still remains very, very attractive to us and some of our clients. We've also heard about India. I think the Modi years have been absolutely fantastic for India. The most amazing thing to me is the way they've done it with actually still a very low debt to GDP profile, very low external debt as well. They've built a middle class. And unlike China, Korea, Japan, et cetera, they've got something like 100 million new workers coming online in the next decade. So, I look at India as having the potential in the same way China had, a couple of decades of 7, 8, 9% GDP growth. I definitely think India has that opportunity. Within Africa, a country that I'd love to see with that growth, they have the same demographic blessing is Nigeria. The current government, I think, has done a good job of tackling some of the thorny issues they inherited. They've managed to deal with the FX backlog. They've got rid of the fuel subsidies. We think the currency is significantly undervalued. It's depreciated by 3x over the last 18 months. And an opportunity to earn 25, 26, 27% yields and take advantage of what we believe is, the strong likelihood of currency appreciation looks super attractive to us and some of our clients.
So can I ask, just reflecting on Latin America and Africa and the opportunities there, what are you seeing in terms of deal flow? Are you seeing more opportunities surface? I mean, given the trends in Latin America, especially with onshoring, is that actually translating now to increased opportunities?
We've seen several big, billion-dollar deals into those countries in the last few months that we would perhaps have not seen from those types of clients and/or in that type of size. So it's definitely picking up, and I think people can see the attractiveness and want to get in earlier and are willing to wait and see that currency appreciation, in particular in Nigeria. I mean, I can sort of feel the room thinking he hasn't mentioned China, so I'm just going to touch on China for a second. Those 400 clients, it is their single most liked investment destination. But at the same time, other than the equity inflows that we've seen in the last few weeks, it is probably the lightest we've seen in terms of asset allocation. The willingness to people to put money to work onshore in Chinese assets is very, very low at the moment. And hopefully the stimulus packages that have been announced will start to turn things around. But we definitely think that it's too early, too soon, and we'd like to see more of those impacts come through and/or more stimulus come through before we can get to a position of sort of high conviction around China. So we are cautiously optimistic long term because they have many, many advantages. But at the moment, we're only cautiously optimistic.
Taimoor, really interested to hear your perspective in terms of the specific opportunities that you're looking at now. Obviously, you've done a lot of direct deals in emerging markets. So where, looking across geographies and sectors, what are you finding most interesting at the moment?
Look, so I think in general, as mentioned before, I think to make your money in EM, you have to be very focused. You need boots on the ground, hardcore diligence, hardcore origination. If you think you're going to get a return with a beta passive style in EM, you're going to get burned very, very, very quickly. We've been very successful in India. We just did a 14x. We announced that it was an online travel business. We had a waste management business in Korea. We did a 10x last year. We also announced that deal. So, we've done very well in consumer, and we've done also very well creating teams of vertical resources and team members who now know healthcare inside and out, to know consumer inside and out. Because, in the private markets, we like to say you have scars on your back, because this is an apprenticeship type of game. You only learn by making mistakes. And the sooner you can make your mistakes, the sooner you can make money. So, don't be a generalist. Go in hard on sectors you like. Try to get a structured deal. Maybe a redemption, maybe a convert, something where you're protected if you're coming in with a partner. And when it's time to exit, you need to run multiple exit streams, both IPO and M&A, and you need to run those hard, keep the bankers honest, and try to get outcomes.
What would you say are some of the more misunderstood elements about emerging market investors investing from an LP's perspective, who are looking to allocate? What do you think are the things that are most misunderstood from LPs?
From LPs, you said? Look, I think LPs, I think in this day and age, I think some LPs are still scared of emerging markets. I think they still, put them in this bucket where we're all in the same bucket. I think, you really need to think about the different countries and the different agendas going on. At the same time, I've always told my team, a asset allocator in London may wake up one morning and say, how do I get more access to India or China? He's probably not saying, how do I get more access to MENA or Africa? So it's also very important for us to really show them what's out there, show them how deals get done, show them how exits happen. And I've personally exited 5 companies in the last 7 years in Middle East and Africa, and supposedly these markets are impossible to exit, but we've been able to get successful exits. So there has to be some marketing from our end as well. I think it's sort of, it needs to be a little bit of, both sides helping each other find the deals.
Okay. So we are almost up for time, but keen to provide a bit of time for closing remarks. So, Samia, would you like to go first? Is there anything you'd like to highlight?
Yeah, maybe. I think it's all a matter of balancing risks and returns. I can talk about a recent investment we've done in clean energy in Turkey. We were pretty disciplined in doing that approach. For example, we've chosen very good local partners, the CAIA group, people who are well reputed with long history in Turkey. And when we've co-invested with them, we created one of the largest solar power plants in Europe, 1.5 gigawatt. And we've hedged the currency, we've done our due diligence, and today the return on the capital employed has been higher than 15%. And now we're looking to expand into wind and more solar plants. So when you really study and do the diligence that is necessary, especially on currency and on large markets where there's enough local consumption, I think it becomes a more interesting opportunity.
Okay. And Hedi, anything to add?
Yeah, sure. I guess maybe just to finish with my views on the next decade in terms of returns for emerging market. My strong belief is that the returns in EM will be probably closer to at par with S&P. I think most of the dollar strength is probably behind us today. The one thing which, in my view, will continue to disappoint is the contribution to technology in terms of returns in emerging market. Unfortunately, the US will continue, in my view, to be the single biggest driver of innovation globally. If I were to give a bit of advice navigating emerging markets, going forward. The single most important thing is to address it and approach it with a local mindset. Don't think of global emerging market as one region. It is not. So either be a specialist on the ground, being able to do and underwrite properly with proper due diligence, as Samia has just mentioned, or you allocate to managers who have boots on the ground. They have a network of relationship to underwrite and to understand the subtleties of these markets. And the last point I would make is it's, in my view, very important to focus more on structural stories and structural themes in emerging and frontier market, and not to try to time them too much and play cyclical plays. Because these markets are less liquid. If you get it wrong, you cannot get out. These are my...
Makes perfect sense. I'm afraid we are up for time, but finally, Mark, any quick final thoughts?
So to misquote Marshall Goldsmith, I think investing in emerging markets is a contact sport. You need to be on the ground. You need to be close to the action. You need advisors that can help you to do that. Obviously, honest bankers, we've heard from Samia. You know, but it's such an exciting area. And I think that, you know, clearly we all believe that the tide is turning, that the returns are available, but you need to be choosy and you need to work with the right people.
Okay, and very briefly, Taimoor, any?
No, I mean, just it's an exciting time. Back good managers, and you'll do well.
Right. Okay. Well, thank you very much for your time, and please help me.